Welcome to COL's Expert Huddle. I'm Charles and I'll be your host for today's event. Okay, so last January 28th, we just had our market outlook. And if I recall correctly, the view there was on the positive side. However, since then, just a little over a month ago, there's certainly been a few significant developments. In the US, for example, uh, inflation rates continue to stay high, and so there has been growing concerns of a more aggressive rate hike cycle. Locally, COVID cases continue to decline, so that's on the bullish side. But most notably, 8 days ago, the conflict between Russia and Ukraine escalated, and these all definitely affected the financial markets. Of course, before we continue, um, our hearts all go out to every single person affected by the war, and we certainly hope the quickest possible resolution for everybody involved. Okay? Having said that, the reality is financial markets don't really go on pause in these such unfortunate events. So today, we try to better understand the impact that this may have to our investments, to our portfolio. Okay, so how does it change the landscape? Okay, how do we as traders or investors change our strategy to continue to manage our portfolio in these times? Okay, all right. So let's begin. So our expert for today definitely needs no introduction. I'm sure each and every one of you already know him. He's been guiding us with our trades for the longest time. So ladies and gentlemen, please welcome COL Chief Technical Analyst, Mr. Juanis.
Wonderful day to everybody, and I'd like to also, of course, share Charles's sentiment. And our hearts really do go out to people being affected by this particular war. And really, we hope that it can be resolved as quick as possible, so that many people around can actually get back into their lives, and especially for those people who are being displaced in this very unfortunate situation. Now, taking a look at that, we began this year looking at a relatively bullish view into our market. And with a lot of these interruptions we've been seeing, we need to be able to take a second look into how these markets have actually been affected, because there are quite a bit of changes that have taken place since we looked at, and since these are quite unforeseen events, we would have to be able to delve back into much of what we saw in terms of the technicals that we reviewed, and to reevaluate things and see what we should do in times of turmoil such as this, and how maybe we can try to be able to navigate back not only our portfolios, but our stock picks, and maybe curb our aggressiveness until we can see some degree of respite in much of the conflicts that we've been seeing abroad. Okay, so let's get into it. So in aspect of what's been going on, it's very important for us to be able to try to make an assessment first of where we have come from, and of course, what our expectations were, and see if there are any changes, because if there are, then we may have to make some adjustments to be able to prepare ourselves moving forward. The last time we met, we wanted to be able to see the index come out of a big area pattern that it would currently been locked inside. If you were to notice the chart that I have here, our index was pinned down roughly at a height of about 7,350. And these two lines you see here, arrow lines, were suggestive of what we were hoping could happen as a positive situation. And yes, if you notice the chart here on the right side, we did get to be able to see exactly that. We did get a breakout condition above this level right here. And if you notice the arrows that we pointed up, sure enough, we did see that the market managed to elevate itself. But unfortunately, here came, of course, certain friction areas in Europe, and this attempted to put us back down or stall the particular rally that we were looking at after that breakout. Now, this is also quite an fortunate event technically, because normally after breakout moves like this, you don't want to see prices go all the way back in. And so far, if you've seen what's happened so far, we've actually come back down to the extension of this downtrend line we have. And this should have been the maximum area for it to come down to. And so far, we've had that. And we've managed to be able to rally off that 71.75 low. And currently, we're somewhere about the upper range of that particular area pattern, which we'll talk about later. But so far, I wouldn't say that things will be called off. We're still very much in a rally play over here, and we just need to be able to get out of this consolidation a second time. But the differences are quite streamlined, because we did get our breakout, and that was the most important thing, because that means that prices are still moving along what was expected. However, the breakout was interrupted, and that forced prices to fall back quite quickly and back into a new consolidation. Now, normally this is not a good move, because normally after a breakout, like I said, you want to see more continuation swings moving upwards, and you don't want to see a new area pattern build in. Now we're in one, so we're going to have to watch that very carefully. The other thing we said is that the US was going to drive a B wave rally before coming into a C wave. A C wave is another corrective wave. And we did get into that B wave. Unfortunately, it only lasted for 2 weeks long. I expected it to last maybe double or triple that period. And again, the reason for which was because of the tensions that was brewing up. And it quickly went back into a C wave to be able to head downwards. We'll look at to the US again later. And of course, possible reactions in the US bond yields and even oil. And we were hoping that these could be temporary tailwinds, because at the time, these were inflationary indicators that we wanted to simmer down. Now, yields only started coming down just recently, so it didn't do that then. And oil prices, as you know, have not gone down. They've just actually managed to spear even higher because of the tensions in Ukraine. And this continues to be one of the major threats we have facing us today. So this part did not come true. And as fortunate as it is, we still have to be able to see where the high point of that oil would likely look at. We'll also look into a chart of oil later on. Now, given the task of looking at how we managed to fare in all these difficult points brewing externally, you can actually see that the Philippine market, if you look at this red line you see here on the right side, it's actually been able to hold itself quite well, despite other markets managed to come down quite a bit. In fact, if you look here on the left side, we've actually walked out showing about almost a 4% gain since March 1. Whereas if you look at the S&P 500, it was down about 9%, with the MSCI World Index down 7.7%, and this was even bigger yesterday. And the MSCI Emerging Market Fund down 4.5%, and in China's market was down 4%. And so we've done relatively well. Now, could it be because we're doing something different? Or could it be because we were actually one of the last to be able to recuperate off coming out of the pandemic lockdowns we've had? And so since we didn't really get to rally a very big amount, it could be that there was nothing else the market could sell. And this is the reason that we've managed to be able to hold our ground given today's conditions. And I hope that we can just stay perhaps in a consolidation while all these pressures are still involved. And hopefully, of course, the end of it being a nice breakout on the top side. And that being, of course, a more optimistic scenario. But we'll look at that later. In terms of Asia, last time I showed this slide, we were actually up here. We were one of the better performing markets in the Asian area. But right now, Indonesia, Thailand have managed to be able to do a little better than us, even a bit in Malaysia. But I am already seeing some stress also coming through their markets as momentum is starting to wane. So we might also see some added corrections inside there. The Philippines is now over here, the fourth into my lineup. And that's followed by China, Hong Kong, India, Japan, and Korea. So clearly, these bigger markets have been under pressure. And perhaps because, of course, the direct impact of inflation and the tensions are actually hitting them more severe than we are. So going back into the PSEi, and I'm just overlooking at what we talked about last time. I showed you a very long-term picture of our index, and my take was we are in a recovery wave, and we still are. We are now hitting the upper band of the first half point of resistance here, and this is also why we're encountering some heaviness. You also see over here, this is also what we call a Fibonacci rally back to about closer to 7405. And this is the reason why the market's having a little difficult time here as well, to put some reason as to why we're getting stuck here. So if we manage to be able to push above this zone, then that should be able to free us to be able to rally closer to the next level, which is I'm looking at somewhere closer to about 7,800, maybe even all the way up to 8,250. Now, looking into the daily chart of that index again, I just want to show you the new consolidation range we're currently locked into. Yesterday, we managed to be able to rally closer to the high end of that area. And because we were back at resistance, we did see some pressure into the market again today. So really the task at hand is, can we punch out above this particular consolidation range? And of course, if not, let us hope that we can try to stay above the lower end of this consolidation range and not fall all the way lower than that, because that would ruin the rallying spirit, and that might delay the process of us pushing out of this consolidation period. So we really need to break over 7,400 to 7,450. And the lower end of our range stands between 71.75 and a more critical range being about 70.60. That's this green line that you see over here. Now, if we do get manage a breakout, hopefully, despite the pressures we are seeing, I wouldn't say it is impossible. But if we do get to be able to see that, I would look at the challenge in two zones, because the first immediate target for me would be about the 7,625. This is just trying to measure the size of this pattern and extend it upwards. And if it punches through that, then we'd be able to move to our next target, which I talked about earlier, between 7,800 to about 8,250. So the only thing really that can ruin us is if this goes below this green line, and if that 200-day exponential moving average is broken, that will cast us back into wider sideways or even a downtrend, and that might take a little longer time to be able to get out of. So these are the pressure points that we have to be quite watchful of. So what we want to see now is, here I have two particular scenarios drawn up. So what I'm looking at as an improving scenario, in other words, things that could get better, would try to be able to do one of these two things. Again, so what we want is, we want prices to rally back to resistance. We can duck in a little bit, but try to punch out of that reactive trend line. And that would set us back into an upward course and allow us to be able to go on to the targets we talked about. A slight modification of that would be this kind of scenario, where we continue to make a reaction, maybe retest these lows, or maybe show a higher low, which would be much better, preferably standing above the 100-day exponential moving average, and then similarly rally back to resistance, pull back for a while, and then break out right after that. And so this is a more optimistic scenario that we want to see. We just need to be able to give the market a little bit more time to wind up, because of course, as you know, we are living in uncertain times, or certain things that could affect us from outside, and the market is just becoming a bit more defensive. In terms of a bad to even worse case scenario, so I've noticed a lot of people starting to ask me that. I guess they want to prepare themselves for the worst in case it happens. Now, this is a small chance of happening, but I will just show you what the potential damage could be, just in case things flare up in that part of the world, and things happen that we were not attempting to be able to count on. So if, let's say, the index manages to be able to fall back towards the 100-day exponential moving average or lower, breaking that, and faltering all the way back down to 70.60, I'm sure that will create a lot of tension into our market, and you will see a lot of selling taking place. Now, again, unless 70.60 is broken, we can still pull out of this, but the recovery time out of the consolidation may take a longer period. Of course, if we see the worst case scenario, which is there's red arrow line you see here, that would involve the breaking of the 70.60 support zone, and that turning our trend in the opposite direction. This could be quite debilitating for us because this would create a much heavier drive of selling that may take a much longer period of time to be able to take ourselves out on, but even may create a little bit of a short-term panic for whatever reason that may have caused it. So, we keep our fingers crossed that we're still very much in line to do something of this first type. And since potentially from the Philippines, there's really nothing wrong, and we are coming out of a pandemic situation, and this is going to be an opportunity for us to actually deliver on a reopening play that we missed out on. And that's why there is still this potential and could be why the Philippines has been hanging on to that. So we have to really look at what is facing us. I mean, in terms of the catalyst, the Philippines has just de-escalated our alert levels to alert level 1, driving that reopening play again. And, we really hope that nothing else untoward happens to be able to derail this. We do have an oversold and divergence signal showing in the US, which I will show you in a while, which could potentially generate a C wave low or a potential interim base. And perhaps the motions of what's been taking place in the conflict might allow interest rates to climb on its own and not too aggressively. And this was also communicated by the Fed the other day. But if they need to, they said that they would be more aggressive. But right now, it looks like they may satisfy themselves with a quarter-point rate hike. And any tempering in the Ukraine-Russia conflict would also give the market a necessary boost. So we keep our fingers crossed that this is, a good possibility, and we hope that clearer minds, level-headed minds, can come back and take control of the situation. And of course, pullbacks in commodities could also stage a potential market rally to be able to come in, because especially if oil were to do that. But of course, we are still watching things because unfortunately, part of the risk we see is that we're still in a very active and fluid environment into the conflict. And there is threat that there could be a prolonged war, which may add to more uncertainty and volatility to markets. The primary causes, at least to people like us, would be obviously the higher oil prices that we're seeing and the other elevated commodity prices that have actually shown themselves into this first quarter of the year. Of course, I really hope, but I hope no other conflicts are added to this. I mean, wars can spread. It can get other people involved, and that's something that we also have to be quite watchful of, because it's hard to say what would happen to people, especially if you corner them and they don't know what to do anymore. They might decide to be able to throw in any other thing that can get other people involved. So it's something that we also have to be quite prepared for. Another risk could be the failure of the US market to base. I mean, I may be seeing this in some technical signals, but create another flare-up, and that could be quite disturbing. Earlier on today, perhaps the reason why a lot of the markets were weak was because people heard news that in Ukraine, their biggest nuclear plant was actually under attack, and there was a bit of a fire that was started to be able to brew nearby towards that plant, which got a lot of people worried, and that's what caused a lot of shakiness into the markets again today. So another issue also is looking again at the potential aggressive rate hike, because if oil prices does not manage to correct well, then that could still be something that the Fed may have to look at. And another thing is, of course, a stronger dollar, which is actually creating a weaker peso, which I will show you later on. I think this is also another threat that we have to be able to be watchful of. And I see a potential breakout in the Peso-Dollar in any moment, if not already. I didn't get to see it earlier on, but of what I saw yesterday, that looked quite crucial. And of course, we have presidential elections coming up, and that is another thing that could be a toying cost to see whether it would affect us or not. But if you recall, in our last outlook, April did tell us that despite these, there is continuity with that, and that we will see growth nevertheless. So let's hope that that also manages to be able to take its cue accordingly, as history provides. And of course, maybe lower risk is any resurfacing of any COVID strains that might interfere once again into the reopening situation that we do have. So just quickly, the S&P 500, and this is what we've seen so far. So in our last outlook, we were looking at this rally here, and it extended all the way back up here. This is what we call a B wave. And after this interim rally, the market really just fell down very sharply, especially after the tensions came in. So this seems to be completing what I was looking down the road, a typical A, B, C Elliott corrective situation. And recently, we've seen quite a bit of a rally. And that helped. I've seen some divergent signals happen into an RSI. A divergence is simply telling you that the force that you see into this decline was actually weaker than the force that drove this decline here, and because of which it might be able to stabilize itself and try to be able to base out from here. A little early to tell, but we keep ourselves watchful of these signals just to be prepared, and that the potential for recovery could still be in place. And of course, what would really be nice is if we can see that this index breaks out above this corrective trend line, and that would clearly give us something to be able to rally on. And this means trying to be able to break away from that 4,500 resistance line that we have. And we also have to keep ourselves open, though, that despite the divergence, remember, you still need to show a basing type of pattern. Normally, one low doesn't make a base. So it's quite possible we could have another decline over here, create another higher low, similar to what you see on this side. And then maybe there we can see a better breakout scenario. And this is being optimistic. I mean, I cannot tell you that this will not go all the way back down here. I'm just trying to be able to portray what a more optimistic scenario is so that we can be ready for the opportunities that may come around it. Now, with regards to interest rates and yields on bonds, this is the bond yield in the United States, and you can see that there was a bit of a correction that we've seen recently, and then a little bit of a rally, but an uptrend line was broken, and so it could be doing something similar to what it did over here, and that means that perhaps the high levels of that interest rate might just pause for a while or consolidate, just like you see here. And that itself should be able to give us a reprieve into the selling that we were looking because of those higher rate structures that they were looking at. Looking at the Philippine 10-year, on the alternate side here on the right side, it too managed to be able to duck in after coming close to that 5.4 or 5.45 range, and then it ducked back to something about 5.25. Now, keep in mind, though, that although we're looking at corrections into this, remember, yields or these interest rate benchmarks are actually still pointing higher, including this. And so all we're seeing are interim corrections in this to try to be able to create a less aggressive stand into it. So remember, we're not telling you that this is going to be a top. This could just be a short-term top. It could correct for a while, and then, of course, it could manage itself up once it sees that rates in the other countries are doing the same thing. So for now, maybe just a temporary retrieve also. Now, in terms of people who are also thinking about, will the increasing of interest rates affect our market? I know we're looking at the war, but this is something that we were looking at prior to that war beginning. Now, if you were to look at the incidence of the Fed rate hikes that took place in the past, I took a stat of what happened to the US market after the emerging markets rather, after looking at 1 year after the first rate hike was made. And if you were to look at the stats that we've seen on various years over here, you will see that on average, on the average rate of all these movements, we've actually seen that the emerging markets have actually climbed 1 year after the first interest rate hike has taken place. So what that means is, I don't think that we have to be able to worry too much about interest rates going up. And I think that will happen. It's happening because, of course, your economies are starting to strengthen. And of course, there are inflationary concerns because business is usually more robust. And of course, we also understand that there could be some logistic issues causing the very sharp up move. But it still means that there still is good demand for business. And this is the reason why markets have managed to be able to be quite elevated. Now, let's talk about war. Now, I managed to be able to borrow this particular image from Joseph Burns, who comes out with an Instagram post, and this is one of a lot of followers for this particular global trader. And he managed to be able to point out one significant thing. he actually took on different cases of different types of conflict: the Vietnam War, the Gulf War, Afghanistan, Iraq, and the Crimean crisis, which we saw in 2014. And he wanted to see how this affected the US market. And if you were to look at the gray bars that you see here, this is the period where such invasions had taken place. And if you notice, you will see that, yes, there were corrective activities that took place during those invasion periods, but it only lasted for a very brief moment. At the longest, perhaps, was the Afghanistan war. Well, this really took a long period of time and could really be the reason why there was a sudden shift down and then, of course, a recovery that took place. But the more unique reason why this took longer in the Afghanistan war was because it caught the US actually in a major downtrend. And you can see over here that it's very different than the recovery trends you see in all the other cases that you have. So given that we are in a recovery phase, and if we were to apply such use of these things, it could be quite interesting for us to be able to understand that perhaps these bouts of weakness we're seeing caused by the war, could this actually be openings of opportunity that we can actually take advantage of to be able to get into our favorite stock while it's happening? And in preparation that after things attempt to simmer down and things normalize, that we would see a recovery wave come from that. So please keep that in mind, as many people always say that in crisis comes opportunity, and even their favorite statements in the stock market, you might think this is morbid, but one of the things a lot of people always talk about here is they say, buy when there is blood on the streets. Now, it doesn't mean that literally, but in some cases, perhaps it does. But all it simply means that because of the conflict that you see, the tension that is created, it might push prices down a little bit untowardly to provide that opportunity that some of us can actually wait for. So always keep your eye open for the opportunities. It doesn't matter whether you're in difficult times or in crisis moments. You ask yourself, how long will this last? Will this be 6 months long? Will this be 1 year long? If this is going to be longer than that, then perhaps we would have to be able to stay out. But if we're only talking about perhaps a few months worth of waiting here, then we should keep our eyes open for the potential opportunities that these things can bring out. Now, if you're wondering what's going on and why is oil so high? Well, the reason for that is because, of course, the situation over here, as Russia being the invading force to Ukraine, one of the things that you have to be able to look at is that Russia is one of the biggest oil producers in the world. In fact, it is the third largest. In Europe, they are the largest exporter in the area. And if you can see that their chunk in the world, they do about 11% of the world's production. But if you were to look at who their main exporting partners are, although China as a single country is the largest, Europe, if you were to tally up all the European countries you see on this list, would actually be a little bigger than what you have in China. So given the interventions that they're trying to see, and why, of course, you would notice that the West is kind of slow in implementing a lot of these things, it's only because a lot of the European partners that they have in NATO is actually going to be quite affected by Russia not being able to produce that oil or send it out, because they have to be able to deal with that. Germany, for example, takes in about, I think, about a third of its oil from them. And so it could hurt if they sever such ties. And so that's why, a little balancing game is being played out here. And such balancing games may make things a little longer. And that's the reason why, of course, that a lot of these movements are taking place at subtle paces, and you just don't see the full force of sanctions come out because they're trying to see how far they can go with them. But this is the reason why, of course, oil is very much on the upside because of the displacement of the ability for oil to flow into the European areas. And the result was quite clear. If you look at oil prices in New York, you would see that in the last so many days, jumping up from roughly $90 per barrel, going up to a high of about $115 or $116 per barrel 2 nights ago. And that managed to be able to create a little bit of a temporary top because it was extremely overbought, as you would see in the indicators over here. But the uptrend remains. Now, although this could park a little bit, remember the momentum for oil is currently on the upside as tensions continue to flare. In fact, with the news I told you about the nuclear plant an area near the nuclear plant burning. That caused, again, commodity prices to be able to zoom up in an intraday fashion. Now, looking into the longer term, you would see here a monthly chart on oil. And I just want to show you how almost vertical it has been in the last 2 years, and picking up to roughly where it closed about 107 yesterday. And the reason why it backed off was because it was a previous high at about $115. So that's the first area of resistance. And the next area of resistance to be able to look for after that would be closer already to about 140 and 147 dollars per barrel. A lot of people have been talking about the potential 120 or 130. That could be quite possible because, of course, you're standing in between these two major resistance points. But I hope that these could be good areas to be able to stifle that advance and cause more consolidation or corrections in oil moving forward. Now, one of the other concerns I have really is into currencies. As you can see over here that the US dollar index has actually managed to be able to push above this consolidation band that you see here, and punching above that particular consolidation range tells me that there's a good chance that it might start to be able to climb towards maybe 98 to maybe even 98.90 being the high band of this channel that you see over here. So an advancing dollar, although you might see it good for that particular currency, may affect our currency. And so this is the peso-dollar rate that you see here on the right side. And if you notice that on the right side, you see a ascending triangle brewing right here. And this had a high of about 51.55 in the peso-dollar rate. I'm not sure, but somebody told me that it managed to punch up above that range today. And if so, and that means that that could break out of that and we could see a further weakening into the peso. And so much so that my next targets for that would be outlined closer to about 52.17, all the way up to even 53 pesos to the dollar. So this is something that we're going to have to keep a close eye on. And based on momentum, it looks like it's primed enough to be able to make that push upwards as well. So that clearly might affect us. So it's something that we also have to bring into the risk situation. So what do we do and what do we have to focus on? So if we're looking at the market in the eyes of a trader, whether you're a short, medium, or long-term trader, I think it's very important that we have ongoing headwinds that have to require us to be able to temper our overall weight in positions. And the reason for this is because given the fact that a lot of question marks can still appear given these times of uncertainties, we can get a lot of volatility coming in. Now, you might be right at the end of the day, but if prices manage to be able to jump up and down, or worse, down a bit largely before it actually starts climbing up, it might force you to be able to sell your positions and take a wider loss. And thus, majority of the reason why many times it's harder to hold a position is because we're either holding too much of it, and that will overcome our ability to emotionally keep ourselves in check. And so my advice would be under positioned. And when I say that, I mean, if you're talking about only having 80% or 50% of your position, I think that'd be a fair assessment of what it is given the context of the threats that we have. Secondly, also putting that into the right perspective is because you may only have a few areas of opportunities that you might see while the market is consolidating. And so we see a very high and mixed trend configurations into our market today. So if you look at the index stocks, we'll show you later on, they are mixed. I mean, some look okay, some don't, some are in between. And that high level of variance tells me that the market's not in a runaway situation right now. And that means you don't need to be broadly positioned. You have to be strategically positioned. And that means being selective in what it is that you're looking at. Focus on issues bouncing over their 20, 50, or maybe the 100-day exponential moving averages. Now, what I mean by that, I took a sample of Jollibee here on the right side. So for example, we see an advance taking place and you see prices making a correction. You see these three lines that you have outlined here. This is your 20, 50, and 100-day exponential moving average. So if you see prices making corrections and you see rebounds from there, either from here or who knows, maybe you can extend a little bit more down here and bounce later. These should be areas that you should look for potential buy zones. let prices correct. Like I said, we're not in a runaway situation. If there is no area pattern breaking out to force on a very sharp up move, take your time and allow a better price to be given to you, and allow prices to quiet down and go to better supportive areas before you start picking up your positions. Now, can breakouts take place? Yes, they can. And should I follow them? Yes, you should. But don't be as aggressive to buy breakouts and uptrends such that in a very aggressive bullish market, normally you just buy it and it goes up 3, 4, 5 days in a row. That's not going to happen today. Breakouts have a high chance of coming back inside because there's a lot of tension in the air. If you notice earlier, we talked about sentiment being part of what you saw. Sentiment right now is very upset with what's going on around us. And it's because of that uncertainty and unwillingness to be able to produce a heavier flow in demand that you will probably see more cascading motions in the market rather than very strong upward fluid movements. That's not happening as of right now. So be careful about chasing prices at this stage of or this phase of the market, because we're not there. Many of you identify this phase to be a weak bull market, and I agree with you. We're not in a very aggressive bull market yet. So since we're not there, do not be outstandingly aggressive, right? Be a bit more, temper that down to something that can be beneficial to you, and it will not take over your emotions. Furthermore, if the S&P 500 can break out of that downtrend line I was showing you, or if the PSEi can break out of between 7,400 to 7,450, then you can start intensifying your position base, right? But it doesn't mean that you can go buy anything that moves there. Please still be selective. I still feel that the market will be quite selective for a little bit, for a more few months before we come into a period that will be much more demanding on an upside. And you want to do this and only be reinforcing positions that are working in your advantage. If you see positions that are falling down from where you bought them, please don't be adding to such things. We do not add to losing positions, right? We want to be able to add when we are arguing from a sense of advantage, not disadvantage. Do not step ahead of downtrending stocks until a valid basing or reversal formation appears. Okay, this is very important. A lot of people I know they see value in stocks, and you might say, okay, I'll be long-term and I'll just buy that because you see all the values from an issue. But remember, it takes time for downtrending stocks to reverse. And it also takes time after they reverse to be able to climb. Later, I'll show you an example of what I mean. So bottom fishing at this stage of the market can get you pinned down. And when I say pinned down, you might lock yourself up in a position and you can stay locked there, because I know many of you, if you buy something and you end up with a little bit of a loss, many of you will likely not sell that until it rallies and makes money. And given that condition, you get stuck in quicksand. And if there's another stock out there that's starting to move while you're stuck in quicksand, you don't have the ability to be able to move to the other side as an opportune trade. So that's also why it's very important to stay under invested as of right now, so you have a little bit of cash remaining for the opportunities you have, and try to avoid getting pinned down on issues that continue to stay weak as of right now. And as a guide, issues that are below their 20, 50, and 100-day averages, I mean, if they're all below these three, this should be your stay away guide. And that means that the trend is still very weak and has not recuperated well enough. And that means that right now you don't see an underlying demand level that's substantial enough to carry it up. Now, one day when we see that the 20, 50, 100-day are starting to break out or starting to push, prices are pushing above that, then you can look at them again and tell yourself that, okay, it seems to have recovered well and there might be better chances for this climbing and less chances for you getting stuck into quicksand in that. And that's when you can come around to be able to do it. So let the stock tell you when it's ready. And like it says here, there's no need for you to guess. Okay, now let's try to be able to focus on the market context. Now, dividing the market into 4 phases. Let's talk about the market improving in terms of the issues that are doing that. The leading sectors, lagging sectors, and the weakening sectors. We'll talk first about the sectors so that you can see where your attention should be focused on. So this quadrant system here shows you that the upper right-hand side shows the strongest amongst all the sectors. And I've highlighted those that you see highlighted pink or purple, and maybe even the highlighted gray ones, not as strong, but still nevertheless a standout. Telling you that these are so far some of the stronger issues to be able to watch over, maybe even play around with. As you come to the lower end here on the right, on the lower right, left-hand side, these tells you the issues that are quite weak. Now, although there could be the weakest sector you have, and they could be down there because some of the heavy ones, like for example, URC and ASEN, heavily affect the CI index, and is the reason why it's obviously standing at this area over here. Now, issues like Jollibee and Meralco have actually been quite strong, and that's the reason why I highlighted it. So just because its general sector is the weakest doesn't mean that there will be no opportunity there. There are a little bit of them, and you might want to keep taking an eye on them every once in a while because these two may have potential, especially if they finish their corrections. Then on a slightly improving or some conglomerates, we've got, of course, AEV, GT Cap as a potential. SM, I didn't highlight these three because they did not really show that good a formation as of yet. In fact, today, I think Ayala Core was quite weak. So perhaps if I were to be able to just keep you pointed, look at the highlighted issues that I have in these sectors and stay there and look for opportunities there. And of course, use these sectors over here as your primary field of where your radar should be focused on, right? Because these ones are still showing where the funds flow are going. In terms of the index 30, this is another spread of it all. Again, the issues in the upper right corner over here tells you the stronger ones, and the ones getting slightly weaker are here in the lower left one. And I think this is a very clear picture of what I was telling you. The market is very mixed. And the market's mixed is because the volumes coming in are very selective at where they're going. They're probably looking at storage. They're probably looking at values. They're looking at stocks that may not be affected by pandemic or wartime or high oil prices. And it's a reason why, of course, you're seeing a very selective band into it. So this tells you you cannot be broad-based, and don't just buy everything in there. And that also means that if you're going to buy an index fund, be prepared that your upsides may be capped because some of those members are obviously on this left side as well. So this, I think, is going to be a stock picker's market, and being a stock picker's market, it will do you much good to be able to filter out which ones are the stronger candidates for you and waiting for a better opportunity for those stronger candidates. So given the context of those 30 stock lineups, I've managed to be able to do a little work for you over here. So what I did is I put 3 categories of activity for each index stock. You can do the same with any other company that you'd like to be able to look at. And so what I did is I broke it down to issues that maybe I should potentially just hold or look for potential buys in. Those are here on the left side. Then those that I am waiting for pullbacks or a breakout. How come? Well, it could be that some issues have managed to rally quite a bit and are now correcting. And because they are correcting, you just don't want to just get yourself involved immediately. Wait for it to pull back toward supportive areas before you enter. Or wait for their consolidations to end. If you see a breakout into what happened into their patterns, then that could be a potential issue for you to do. And lastly, you will have wait for a bottom over here column. And that means that these particular stocks are currently in downtrends and they've not shown any advancing signals to reverse as of yet. And given that context, you might want to stay free from there or stay light into them for the meantime until you see a reversal conditions come out. I'll talk a little bit about these reversals when I show you an example of one a little later on. Now, if you notice, there are some names that I put also under hold, buy, or even wait to pull back or breakout. For example, GT Cap is here, BPI, BDO. They appear on both areas because they're kind of in between. And because they're in between, they could actually still pull back a little bit more. And because of that, that's a reason why I had to be able to show you it could be either a hold or a buy option for these issues. And maybe if not, then you wait for the consolidations to finish and wait for them to break out before you move through. So use this as your guide to be able to sort out that which ones seem to be a little bit more beneficial in the technicals. That's this one. Then those that are still generating preparatory movements, that's the one in the middle. And those that are still kind of weak, those are the ones in this right one. So try to be able to take advantage of these. Now, let me show you how to be able to enact some of those things. For example, if we're looking at a stock like Aboitiz Equity Ventures, you can see that prices are now trying to consolidate into the short term, and they're winding up over here. And I think eventually they will attempt to be able to make a decision off this band that you see here. So far, the indications seem a little bit better rather than worse to be able for a potential breakout. And we're still waiting for the decision on that. So in this particular case, you could actually hold your position or wait for a potential buy condition if it goes to support, or if it actually shifts and breaks out, then you have a potential buy situation as well for Aboitiz Equity Ventures. Below that, we have ICT, where yesterday we saw a very, very strong, powerful up move, breaking over its 220 peso range. So here's an example of a breakout buy. And this generated that buy signal because it managed to be able to successfully hold on to its area pattern, standing over two moving averages that you have over here, and then of course giving you a buy signal in your MACD. So there are good indications given the context of what you have there. Now, for those that are kind of in the middle, Meralco is an example. I mean, we have a nice advancing movement, but then a couple of days ago, you'd see a very sharp decline that took place, cracking its uptrend line and tagging its moving average. MACD has read back into a sell, so this tells you that stock's weakening. And so it might need a bit of a correction after this very aggressive motion. So we will now watch the 20, perhaps the 50-day moving average to see if these, or maybe even this one, could actually give you a better opportunity to buy Meralco. But given the fact that, remember, it's still into an uptrend, we're just waiting for a little bit more of correction time to be able to get a better window to enter this particular stock. GTCAP is another stock, for example, that's also generating an area pattern. But unlike this, it's actually stayed on a very bigger area pattern. If you see a weekly chart here, it's actually stuck sideways for a very long time. And so right now, in this particular case, we'd really have to wait for prices to be able to break out from here before trying to be aggressive in buying this. Because if we call this wrong and this corrects back here or here, it could actually be changing its shape to a much less aggressive pattern and might take a longer bit of time to be able to break out of that. As you can see, momentum is still quite weak because the area pattern is still very much entrenched. Now, here's an example of a weaker chart. Okay, I mean, ASEN. Now, ASEN was doing well, of course, late 2021, but then it started to correct come this year, and it corrected quite heavily. Downtrend has currently been in place, and we haven't seen any cessation to that selling as of yet. You see the stock price is below the 20, below the 50 and 100-day moving average. And given the standards I gave you earlier on, stocks beneath these moving averages, we stay away from. Now, when we say we stay away, it doesn't mean that you do not watch it, because it's actually fallen quite a bit. Now, it may not be valuable, but technically it's fallen enough or enough correction time to be able to ask us to start watching for potential reversal patterns here. So one day, if we see this downtrend break and you start seeing that your 20 or 50 days start to break as well, that could be your initial signs that the potential reversal pattern may be coming in. Do take this note though. It takes time for reversals to come out. Okay, so it's a process of bottoming. It's not a single up move like this that will go straight up. That will not happen. And the reason for that is because after a selling wave, an accumulating wave has to come in first. And that means normally after the first breach or push up that you would see, it will come back down, recollect itself into a new consolidation pattern. And in that consolidation pattern, you will see the accumulation. Let me give you Ditto as an example. Ditto over here broke out of a downtrend line here, which actually extended far up here. And after that push up, look at what it had to do. It actually fell back down to the previous low. And then it tried a second time. Then it worked. It punched above the 20, 50, 100-day moving averages. It even hit the 200-day moving average. But right after that, it fell back down. And unfortunately, it even broke through this rallying trend line that you have. So this temporary rally is finished. And now a new consolidation is going to build somewhere between this high and this low. It's a very big range. So the temporary recovery has stopped, and now you're going to generate a consolidation pattern. And now we will see if accumulative interest will come in. If this can build a range, especially stay a range that this is higher than this previous low, then that could potentially be a good sign for Ditto. But if this falls back down to the previous low or lower, I think you and I know that that is a continued decline, and that means there's going to be a delay in the potential reversal consideration for Ditto. So these are examples of how we have to be able to look at the market and try to be able to tell the difference between what is stronger, what could be a potential strength play for you, and things that we don't have to watch immediately, but keep an eye on just in case certain things show a reversal conditions. Your immediate activity will probably be in the first two columns, and only take some time before you probably cash yourself back into this. So keep yourself focused where you should be. So in summary, we see the PSEi, swinging currently into a new consolidation, and it really has to keep chipping off into resistance, but only a potential break over 7,400 to 7,450 can get ourselves back on track into the recovery. Now we want to see a higher low base here and then potentially generate that breakout so that it can create lift and tag that 7,800 to 8,250 markers that we set off for ourselves actually in the beginning of the year. Without that breakout over the 74,450 level, that means it's going to take us a longer waiting period, and you'll probably see a lot more zigzagging motions into the market. And that's where it might be a little, too rough for many of us to be too heavy in position. And that's the reason why, please keep yourself at a very accommodating level in terms of position in the market. Not too heavy, because you need to be a little bit, you have to be able to adjust to the signs of the times. Also, it doesn't mean that we are in a very detrimental state here, because the only thing that can really club us on the head and push us really down is if the index breaks below this critical support area of 70-60. Only that can ruin us. So other than that, you should be watching for potential pullbacks into the market and for potential entry points. Stay selective in your buyings and focus on mainline issues and reopening plays. I think I've clearly stated this in our first outlook in the early part. That has not changed. And I told you stay and trade issues that are bouncing off their 50 or 100-day moving average. Those are preferred because at least you're coming from a more substantial area of support. And try to be a little bit patient with breakouts, because we are not in an extremely strong bull market. We are in a weak bull market, a bull market that on breakouts you will see prices come back inside. And so this is the reality that we're going to have to deal with. With regard to the opportunity of the US, we are seeing some divergent signs after an ABC wave, and we're hoping, crossing our fingers, that we could see a potential end to this C wave and allow the US to be able to generate some more upward action. As I said, I'm calling it a bit too early, and I think we need more confirmation, but it would pay us to be very much prepared just in case we do see it, because it would give us a nice nudge upwards. In terms of headwinds, I will be the first to tell you that it is still over our heads. And it exists, whether it's Ukraine, the higher oil prices we're seeing, now the weakening peso because of the strong dollar, and who knows what other unforeseen effects that some of the sanctions that being leveled on Russia and their members could be, because that could spill over to the rest of the world. And it's something that we haven't seen. We're the early part of this. And it's very hard to tell you whether it's just going to last another month, 2 months, or longer. Could it only have a week or two left? Probably not. But we have to be able to be prepared that this could stay into the short term. Whether it's going to go into the long term or not really depends on whether it escalates. And I am not a military analyst, and it'd be difficult for me to tell you, and anyone else to actually tell you what's going on, the minds between the leaders of course, what's happening in Russia, Ukraine, and the West. And of course, try to be able to be quite remunerating while things are still very difficult. You have to be nimble, and you have to be ready to prune positions that are put at a compromised situation, especially if you see them breaking their 100-day moving averages or even their 200-day moving average. you might want to be able to step out of these first for the meantime and just wait for things to clear before you head back. And also give you the ability to raise some cash in case opportunity lies elsewhere, because we don't want to get pinned down during these periods, especially if something else were to happen and you have a stock falling down and you're bleeding. It becomes much more difficult to sell the stock that way as it's falling down deeper and deeper. I think many of you have probably felt that before. I sure have. And my learning lesson today is I don't want to stay in there while that thing continues. And I want to be ready and willing with my cash ready to be able to buy opportunities that they surface. Not for the opportunity to finally come and I'm still stuck on some other issue. So I hope that these particular essentials can help you out in this particular market situation.